In this presentation, we will take a look at an example of a forecasted departmental income statement. This is going to be our data. We have the income statement for the prior period, C and M being our two departments, and of course the total between them. We're going to be projecting or adding or thinking about adding a new department, Department P, and therefore going to have to add that to our forecast. The information for P that we have projected to be will be sales 53,000, gross profit margin 65%, salaries 8,500, advertising 1,000, store supplies 400, and equipment depreciation of 700. Added information: P will replace space currently used by the other departments. So in other words, we're not going to be building a new office or renting new space for P. P is going to be taking over some of the space that we currently have that is in use by C and M. So C and M departments are going to be replaced 20% and 25%, which will then be going to P in terms of office space. Office department expenses allocated in proportion to sales. Office department expenses expected increase 7,200 to the office department expenses. That's going to be these items here. And then there's going to be an increase in sales for C and M. We're going to say 8%. So we think these items are going to go up. The sales lines are going to go up, projected next time period, by the 8%. And then, of course, we're going to add P, which has got the sales number of 53,000. Store supplies increase in proportion to sales. So when we're considering the store supplies, it's going to go up with relation to the increase in sales, in essence, an 8% increase. So let's start to construct our projection. We're going to have C, M, and now P, our three departments that we will be constructing for. We're going to say that the sales is going to be our top line number. How are we going to get that? Well, we're going to start with prior year sales. So we had sales last time, 170,000, and we're projecting it to increase by 8%. We saw on the data on the prior slide. So it's going to increase 8%. So times 0.08, and that's going to be 13.6 plus the 170,000 or the 183.6. We could do that a bit faster by saying it's 170,000 times 108% or 1.08. If we move the decimal over 108%, that's going to be the 183.6. Then of course we do the same thing with M. So 115 times 1.08. That's going to be the 124.2. And then P is being drawn from this number. Then we're going to get the cost of goods sold, and we're going to assume here that the cost of goods sold is in relation to sales, because it typically is going to be. The cost of goods sold is going to be in relation to sales, and therefore we'll still have an 8% basic increase in the cost of goods sold. So with the cost of goods sold, we've got 83300 times 1.08. Same process, 89,964. We've got the 71300 times the 1.08. That gives us the 77. And then there's a couple different ways we can work this out with P. We know that the gross profit margin is 65%. Now remember, the gross profit is going to be the gross profit divided by sales. And we're looking for cost of goods sold. And we know that the gross profit is sales minus cost of goods sold. So in other words, we know that if the gross profit is 65%, then 1 or 100 minus 65%, 1 minus 0.65, 0.35 or 35% must be the cost of goods sold. That's one way you can calculate it. You can think of different ways to calculate it, but we're going to say 35% times, and then we're going to say the sales item 53,000. So that's here. And that gives us our 18,550. Then we've got the gross profit, subtracting those two out for the gross profit. Then we're looking at our direct expenses. So the direct expenses, those that we can apply directly to our items, and we don't have to use the allocation for them. We include the salaries. So we're picking up the salaries from last time where we had the 20, we had the 8,7, and that's going to give us our totals. And then we've got another 8,500. We're thinking the salaries aren't going to change because they're salaried. So that's going to be straightforward. We just add the new item for P in our projection. And then we have the advertising. We were at 1,400, the 200, and then we're adding another 1,000 for P. So we're taking those directly from our prior numbers. And then we've got the store supplies used. For that, we're going to be taking the 950, and we say that it increased in the same proportion as sales. So we think it's going to increase in the same proportion store supplies. That would be a reasonable estimate. So we're going to take the same thing that we did the sales. There's the 950 times 1.08. So that's going to be the 1,026. We're going to take the 400 times 1.08. That gives us the 432. And then if we add those up, we get our totals. We got the 400 for our new department P. And then we have the depreciation on the equipment. We're going to say that's the same. We're going to keep it at basically a straight line method. It is what it is. So 1,700, 500. We think that for P, we're going to have new equipment that we're going to depreciate at 700 in our projection. So that's going to be our direct expenses. If we add those up, the 20 plus the 1,4 plus the 1,026 plus the 1,007 is the 24,126, and so on. Then we have the allocated expenses, or the indirect expenses. We're going to be looking at the rent and the utilities. That's going to be the first calculation we need to take a look at. So to do that, we can look at what we had last time. We had the rent expense and the utilities expense. So we're going to start with the rent here. We're going to say, here's the prior year rent. It was the 7,120 C and 4,080 for M. So that's going to be these two items. Obviously, nothing was there for P. P wasn't around. And then we're going to be allocating 1/5 from C to P. Why? Because we said it was a 20% allocation. If we think about that in terms of a ratio, it's 1/5, 1/5, or 20%. So what we're going to do is we're going to say, okay, 1/5 of that is going from C to P. So how would we do that? We'd say, okay, well, 7,120 divided by 5, 1/5, would be, and you can multiply it times 1/5, 1,424 is going to be out of C and being allocated to P. And then if we consider the amount from M allocated to P, we see that's going to be 25%, which of course is 1/4, 1/4. So 1/4 is going to be going from M to P. So last time we had 4080 divided by 4, 1/4 is 1,020. It's going out of M and into P. So that's what we have here. If we take a look at our totals, then we're saying C had 7,120. We're going to take out 1/5, giving us 5,696. M had 4,080. We're taking out 1/4 to bring it down to 3,060. That 1/5 from P, that 1/4 from C, that 1/4 from M to P is 2,444. So we're going to have our same number here. The rent's the same. This is our new allocation. Now we're also going to be looking at the percentages and use those percentages for the utilities percent. So in other words, we're going to say, all right, well, what's the percentage? And I'm going to use this allocation of the rent to apply out the utilities. That's going to be our activity base, in other words. So we're going to say, all right, here's the 5,696 divided by the 1,120. That's about 5086. And then here's the 3,060 divided by the total 1,120. That's about 27.32%. And then we have the 2,444 divided by the total 1,120. That's about 21.82%. Those, of course, adding up to 100%. We can then use those percentages to allocate out the utilities. So in other words, this is going to be the rent allocation. These are the percentages that we're going to be using to allocate out the utilities. So the utilities then are at 4,300. And we're going to take that 4,300 and use these percentages. 4,300 times 0.5086. There's rounding involved here, as we know, about 2,187. And this is a forecast, so we expect rounding. That's okay. 4,300, and this 4,300, by the way, is coming from there, times the 0.27.32, and that's going to be about this number, and so on and so forth. If we add these up, 1,287 plus 1,175 plus 938, we get the 4,300. So that's going to be our allocation. So we're going to take those two items and allocate them out in our projected income statement or forecasted income statement. Then we're going to have the share of office department expenses. That's going to be this item that we're going to need to then allocate to office department expenses. We're going to be using sales in order to do that. Now again, remember that sales has nothing to do with really the office department expenses, but we think that the ratio of sales is an appropriate activity base for us to use in order to apply out the office department expenses. So to do that, we're going to take the current year sales. So this is the sales amounts that we just pulled over. And we're going to record the percentages related to them. In other words, 183,600 divided by the 360,800. That's going to be about 50.9%. If we take the 124,200 divided by the 368, we get about the 34.4% and so on. These will be our percentages. They add up, of course, to 100%. Then we're going to take the total current expenses. That was at the prior year expenses. That's going to be the 16,000. That's what we had last year, our 16,000. And we said that they're going to be increased by 7,200. That's what we're projecting to happen next year. So in total, it's going to go up by another 7,200. So we're going to start here. Our total is here. And then we just simply break this number out in accordance with our percentages. So we know what the total is, 16 plus the 7,002 for 23,200 times the 0.509 is about 11,808. And again, this 50.9 is rounded, so it's not exact right there. And then we got the 23,200 times 0.344 is about this number here. And again, there's rounding difference in these numbers. So again, it's a projection. That's okay. So we have those numbers that we can then apply out. That's going to be the share of office department. Then we got the total allocated expenses, which is this plus this plus this all the way across for CMP department and the total. That'll give us the total expenses. The total expenses being the direct expenses. So we've got the 24,126 plus the 19,689 and the allocated or indirect expenses for the 43,815, and then we'll get to the net income, that being the gross profit 93,636 minus the expenses of the 43,815 for a 49,821 on our net income. And again, that applies out all the way across C, M, and P and the total.